Hi everyone, in this video we'll be going over A-Level Accounting 2023 Specimen Paper 4 question number 1. So this paper 4 is an addition to the existing papers. Previously we only had paper 1, paper 2 and paper 3. And in the previous paper 3 we used to have 6 questions, each of 25 marks, 4 of them related to financial accounting whereas the 2 of them related to cost and management accounting. And now paper 4 is made up of those 2 questions which were related to the cost and management accounting. And in this paper as well, we only have 2 questions, each of 25 marks, and we're also given a time limit of 1 hour, which means that ideally we should be spending about 30 minutes to complete each question. And in this video as well, we will be attempting to solve this question under 30 minutes. Now, without any further delay, let's get started. W Limited uses a budgetary control system. To prepare the budget for the month of May, the directors of W Limited estimated a production of 1,200 units and fixed overheads of 30,000. The following budgeted data is available for the production of 1 unit. We require direct materials of 2 kilos per unit and the rate per kilo will be 12. For direct labor, we require 4 hours for each unit, and for each hour, we require 15 to be paid. And the fixed overheads is to be charged to the product on the basis of direct labor hours. Alright, the actual number of units produced and sold in May was 1120 and the actual and budgeted unit selling price was 135. Let's have a look at our first question. We need to state 3 advantages of using a budgetary control system. So the very first advantage of using a budgetary control system is that there will exist some sort of coordination among departments for allocation of resources, because we already have a planned budget, and according to it we need to allocate the resources for each department, and in order to do so we require coordination. So that will be our very first advantage, coordinating among departments for allocation of resources. The second advantage would be of setting a target for each department to achieve, because we're preparing a budget and essentially we're preparing a target for each of the departments. So that would be an advantage. Let's write it down. Setting target for each department to achieve. And lastly, when there is a set target, it may motivate employees in order to achieve those targets, right? So that could also act very advantageous to the company, motivating employees towards objectives. Alright, now let's move to the second part. We need to prepare a statement to show the total flexible budgeted profit. And remember, while preparing a flexible budgeted profit, the output that we will be using will be the actual output, whereas all of the costs will be the budgeted ones. Okay, so we can start with our revenue. Let's have a look above. We were told that the actual number of units produced was 1120, so we will be using this number of units for each of our cost headings. And we're also told that the unit selling price was 135. So now in order to figure out the total revenue, we just need to multiply these two numbers. Let's do it. That will be our total units, which is 1120, times our selling price per unit, which is 135. And this gives our total revenue to have the value of 151,200. Now we can move towards our costs. So the very first one will be direct materials. Again, we already have our number of units, which is 1120. So now we just need to figure out the direct materials cost per unit. Let's have a look above. We are told that each unit requires 2 kilos of direct material and the rate per kilo was 12, which means that the per unit cost of direct material is just going to be the product of these two numbers. So that will be 2 times 12, which results in 24. Let's multiply this to our total number of output. So that will be 24, which gives the total direct materials to be 1120 times 24, which is 26,880. And since this is an expense or a cost, I'm just going to write it down in a bracket indicating that this needs to be subtracted. Then the next cost is of direct labor. Again, our total output is 1120, so we just need to multiply it with our direct labor per unit. Let's have a look above. we can see that each unit requires 4 hours of direct labor, and each hour of direct labor has a cost of 15. So in order to figure out the direct labor cost per unit, we just need to multiply these two numbers. That will be 4 times 15, which results in 60. Let's multiply it to our total number of output. So that will be times 60. So our direct labor cost is 1120 times 60, which results in 67,200. Again, this is a cost, so I'm just going to write it down in a bracket. Now our next cost will be that of fixed overheads. Again, we have the total number of output of 1120. Now let's have a look above. We are told that for 1200 units, the fixed overheads is of 30,000, right? So for 1200 units, the cost is of 30,000. And if we were to apply our unitary method for 1 unit, the cost will be 30,000 divided by 1200, which is $25. But remember that our fixed overheads is to be charged to the products on the basis of direct labor hours, right? So let's figure out the cost per direct labor hour. For 1 unit, we have the cost of 25, and we know that each unit requires 4 hours of direct labor. So we can just say that for 4 hours, we require 25, which means that our per hour rate of fixed overhead is going to be 25 by 4, which results in 6.25. Okay, since we are multiplying the fixed overhead cost to our total number of output, we will be utilizing the per unit cost of 25. Let's multiply this. So that's 1120 times 25, which results in our fixed overheads to have the value of 28,000. This concludes all of our costs as well as revenue, so we can just figure out our flexible budgeted profit. And the profit is just going to be the sum of these four amounts. That's 151,200 minus 26,880 minus 67,200 minus 28,000, which results in our flexible budgeted profit to have the value of 29,120. This concludes the second part. Now let's move towards the third one. We're given additional information. So these are the actual costs incurred for me. We have our direct materials, direct labor, and fixed overheads. Let's have a look at our question. Now we need to calculate the following variances. So the very first variance we need to calculate is direct labor rate, which means that we're just comparing the rates, and that is between the actual rates and our budgeted rates, right? So we can keep our basis constant, and we can keep our basis as the number of actual direct labor hours, which means that our direct labor rate variance is just going to be the number of actual direct labor hours times, since I said before, this is just a comparison between the budgeted and actual rate, that is just going to be the budgeted rate per hour minus the actual rate per hour. Okay, let's open this bracket. So that will just be number of actual direct labor hours times budgeted rate per hour. And the next one is just going to be number of actual direct labor hours times the actual rate per hour, which results in the total actual direct labor hour, right? So that is just going to be the total actual direct labor cost, which is given above. All right, now let's substitute the values. The number of actual direct labor hours is 4,424. Let's write it down. Times the budgeted rate per hour, which we calculated above. So the budgeted rate per direct labor hour is given to be 15 right here. So we just substitute this value minus the total actual direct labor cost, which is given right here to be 67,466. Let's write that amount down. Now this gives the direct labor rate variance to be negative 1106. And this is a negative value, which means that our budgeted rate is lower than the actual rate. And when our actual cost is greater than the budgeted cost, that is not something good for the company, which means that this variance is an adverse one. Okay, now we need to figure out the direct labor efficiency variance. We're talking about efficiency here, which means that we can keep our rate constant. So we can keep our rate to be budgeted rate per hour. And we're just comparing the number of hours, right? So what we can do is we can compare the number of budgeted direct labor hours to the number of actual direct labor hours and just multiply it to our budgeted rate per hour. Okay, we have the number of budget direct labor hours above, right? And the basis will be our actual output. So we can see that the budgeted rate was 4 hours per unit and the total unit produced was 1120, which means that our number of budgeted direct labor hour is just going to be the product of those two amounts, right? So that's 1120 times 4 minus the number of actual direct labor hour, which is given right here to be 4424. And we can just multiply it with the budgeted rate per hour, which was 15. And this gives our direct labor efficiency to have the value of positive 840. Since this is positive, we can say that our budgeted direct labor hours were greater than the actual direct labor hours, which means that we had to input lower direct labor hours. So our efficiency is higher, which is a favorable condition. So this is a favorable variance. Now we can move towards fixed overheads expenditure. So this is quite easy one. We're just comparing the fixed overheads expenditure, which means that we can easily subtract or compare the budgeted fixed overheads with our actual fixed overheads. So the formula is just budgeted fixed overheads minus the actual fixed overheads. The budgeted fixed overheads was given above. Let's have a look. We can see that the total fixed overheads, the budgeted one, was 30,000. So let's write it down. That's 30,000. And our actual fixed overheads is given right here to be 29,500. So we're just going to substitute this amount. And this gives our fixed overheads expenditure variance to have the value of positive 500. And a positive 500 indicates that our budgeted fixed overheads was greater than the actual fixed overheads. And since this is a cost, a lower actual cost is a favorable condition for our business. So this is also a favorable variance. Now, the next one is fixed overheads volume. So we're comparing the volume, right? And we are told that our fixed overheads was to be allocated on the basis of direct labor hours. So we're basically just comparing the total direct labor hours utilized. Our basis can be the rate per direct labor hour. We can keep it constant. So the formula is just going to be rate per direct labor hours times our budgeted units times the number of direct labor hours per unit minus actual units times number of direct labor hours per unit. Let's have a look above. We figured the rate per direct labor hour to be 6.25, right? So this is the rate we will be using. Then our total budgeted unit was 1200, whereas the actual unit was 1120, and the direct labor hour required per unit was 4. So let's just substitute these values. That's 6.25 times our budgeted units was 1200 times the number of direct labor hour per unit is 4 minus actual units was 1120 times the number of direct labor hour per unit was 4. Now this gives our fixed overheads volume variance to have the value of positive 2000. And here a positive value means that our budgeted unit is greater than the actual unit. And our actual unit being lower than budgeted unit is not a good thing for the company, which means that this variance is an adverse one. Okay, let's move to the next part. We're given additional information. The directors have identified that there was an adverse total direct materials variance of 420. Now we need to prepare a statement to reconcile the flexible budgeted profit from B with the actual profit. So whenever we're trying to reconcile the flexible budgeted profit to the actual profit, we just need to adjust all of our variances. And what we do is we add all of our favorable variances and subtract all of our adverse variances from the flexible budgeted profit. And we will be doing the same thing here as well. Let's start with our flexible budgeted profit. Let's have a look at its value. We figured it out in part B and it was 29,120. Let's write it down. Now the next step would be to adjust all of our variances. So the first one we have is total direct materials variance. Let's write it down. Total direct materials variance. And it is a 420, but this is an adverse value, so we need to subtract it. So that's 420, but in a bracket. Now the next variance that we figured out was direct labor rate, which was 1106 adverse, which means that we need to subtract this value. Let's do that. That will be direct labor rate variance with an adverse value of 1106, so we'll be subtracting it. The next variance that we figured out was direct labor efficiency with the value 840, and this is a favorable one, so we should be adding this amount. Let's do that. That is the direct labor efficiency variance with the favorable value of 840. Then the next one we figured out was fixed overheads expenditure variance with the value 500, which is again favorable, so we should be adding this amount. Let's do that. That is fixed overheads expenditure variance with a favorable value of 500. And the last one we have is fixed overheads volume variance of 2000, which is an adverse value, so we should be subtracting this amount. Let's do it. So that's going to be fixed overhead volume variance with an adverse value of 2000. Okay, this concludes all of our variances, so we can figure out the actual profit now. And that is just going to be the sum of these amounts. So that's 29,120 minus 420 minus 1106 plus 840 plus 500 minus 2000, which results in the value of 26,934. This concludes the fourth part. Let's move to the next one. We are given additional information. So W Limited received orders for goods to be supplied in June from 3 customers only. So we have A, B, and C, and the unit sold is 300, 700, 400, which means the total units sold is going to be 300 plus 700 plus 400, which is 1400. All right. Then we are given unit selling price for each of those customers. The budgeted data for May for the production of 1 unit remains valid, which means that the budgeted direct labor per unit and direct materials per unit remains valid. However, W Limited has to pay an overtime premium of 75% to workers for production in excess of 1200 units in a month. Alright, W Limited is considering 2 options only. The first option is to accept the orders of A, B, and C, whereas the second option is to accept the orders of A and B only. Okay. Now for this question, we need to advise the directors which option they should choose. We need to justify our answers by showing appropriate calculations. We can ignore the fixed overheads, and by making reference to non-financial factors. Okay, let's prepare our calculations first. Let's start by preparing the calculations for option 1. We can start with our revenue. Okay, so for option 1, we will be accepting the orders of A, B, and C, which means that our total revenue is going to be 300 times 135 plus 700 times 130 plus 400 times 132, which results in the value of 184,300. That's our revenue for option A. Let's write it down. That's 184,300. The next step would be to subtract all of our costs. So the very first one is of direct materials. And the previous direct materials per unit remains valid. So we can just write that amount. And we can see that the previous direct material was 24 and the previous direct labor per unit was 60. So we're just going to use these amounts. For our option 1, we are accepting all 3 orders. So that's the total of 1400 units, which means that the Direct material is just going to be 1400 times direct material per unit of 24, which results in the value of 33,600. Let's write it down. So that's 33,600, which is a cost. So I'm just going to write it down in a bracket. Then the next one is of direct labor. Direct labor rate per unit was 60 previously. So the total direct labor now is going to be 1400 times 60, which results in the value of 84,000. Let's write it down. And lastly, we also need to give overtime because we are producing 1400 units and we need to give overtime for units in excess of 1200. So the overtime is just going to be 200 because that's the total extra units that we are producing times 60, and we only need to pay the premium of 75%. So that will be times 0.75 as well, which gives the overtime for labor to have the value of 9,000. Let's write it down. This concludes all of our variable cost, and we can ignore the fixed overheads, right? So we can just figure out the contribution. The contribution for option 1 is just going to be the sum of these four amounts. That's 184,300 minus 33,600 minus 84,000 minus 9,000, which results in 57,700. Okay, now we repeat the same process for option 2. We again start with the revenue. But for option 2, we are only accepting the orders of A and B, right? So the total revenue is only going to be 300 times 135 plus 700 times 130. We're completely ignoring this, which gives the total revenue to be 131,500. Let's write it down. Then we subtract our direct materials. For option 2, our total units is just going to be 300 plus 700, which is 1000, right? So the total direct material is going to be 1000 times the direct material per unit of 24, which results in 24,000. Let's write it down. Then the next step would be to subtract the direct labor cost. Let's have a look above. So the total number of units is thousands and the direct material per unit is 60, which gives the total direct labor cost to be 60,000. Let's write it down. And we do not need to pay any overtime for option 2 because the total number of units is only 1000 and that is not in excess of 1200. Right, so this concludes everything. We can now figure out the contribution. And remember that direct materials and direct labor are to be subtracted. So let's just put it in a bracket. Now the contribution is the sum of these three amounts. That's 131,500 minus 24,000 minus 60,000, which results in 47,500. Okay, now based on our calculations, we can see that option 1 has a higher contribution, right? So based on contribution, option 1 is better than option 2 because it has the higher contribution. Now we also need to make reference to our non-financial factors. Let's do that. Under option 1, we know that we have the total number of units of 1400 and our capacity is 1200, right? So this extra capacity can be fully used and we are utilizing all of the capacity. Let's write it down. Under option 1, capacity can be fully used, whereas under option 2 we are only preparing 1000 units, right? So there is some sort of spare capacity which can be kept in reserve for other urgent orders. Let's write it down. Under option 2, spare capacity can be kept in reserve for other urgent orders. Now let's talk about the overtime factors. Under option 1, we require overtime payments, which means that the workers may be happy to work overtime as they will get overtime premium as well. Let's write it down. Under option 1, workers may be happy to work overtime as they get overtime premium. And this premium is the 75% extra payment that they are getting for the additional 200 units, right? But under option 2, we require no such overtime working, right? And since there is no overtime required, it might improve efficiency of those workers. Let's write it down. Under option 2, there is no overtime required, which may improve efficiency. Now, based on these factors, we need to make a decision and advise the directors which option they should choose. Personally, I will go with option 1 solely on the contribution, because the contribution is way higher as compared to option 2. Let's write down the decision clearly. The decision is that the directors should choose option 1 and accept the orders of A, B, and C. Okay, this concludes our 5th part as well as this entire question number 1 of 2023 Specimen Paper 4. If you found this video useful, make sure you like the video and leave a comment below. And make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.